Harvard Business School Online offers a flexible and engaging way to learn vital business concepts. Our professional certificate courses are offered 100% online and can be completed on your own time. Try a free business lesson at hbsonline.info and discover how Harvard Business School Online can help you take the next step in your career. Go to hbsonline.info today.
Welcome to the Money and Investing Show. This space is all about managing money and kickstarting you into the world of investing and finance. A series of bite-sized episodes designed to simplify and equip you with the tools on how to get you started, along with some tips and tricks for those already investing. Stay tuned for today's episode with your host, Dale.
Hi everyone, and welcome to another episode of the Money and Investing Show. I hope you are enjoying all the content so far. However, if there is something that you would like me to discuss or feel that there's something that I just need to go into a little bit more depth, please send me an email at info@capitalmediagrp.com. In last week's episode, I talked a lot about where to find information and how to look for companies that you might want to buy. And so this week, I'm going to continue on with that theme and start to talk about some of the things that I look for when starting to analyze a company and build out my investment thesis. Now, I've mentioned an investment thesis a few times in previous episodes. But to give you a better understanding of what it is, we're going to go a little bit more in depth. But it's essentially your reasons for why you're buying that company. Now, it's always a good idea to write these reasons down so that you can go back and check how your investment is performing and if it still aligns with your initial analysis and reasons for getting into the stock. Now, when I say write this down, I don't necessarily mean a pen and paper, although if that's the way you like to do things, by all means, don't let me stop you. I, on the other hand, like to build out my thesis in Excel. It allows me to add numbers and texts, and I like to add a few formulas, and then I can link everything back to a summary page. The reason that we build out a thesis is one, about doing research on a company that we might like, and then the reasons why we might be buying it. But it also helps to take some of the emotion out of the day-to-day volatility that you might experience throughout any given investment horizon. So say that we invested in my Coffee Co example from one of the earlier episodes, and if you can't tell yet, I drink probably too much coffee. But say the reason we invested in Coffee Co is because they are a subscription business and they are growing their customer subscription numbers year on year. They're expanding into additional markets, and you might feel confident that their share price in 5 years is worth more than it is today. So you might have bought into Coffee Co at, say, $10, and part of your analysis says that it'll be worth maybe $20 in the next 5 years. And you purchase into the stock, and all of a sudden there's a market downturn or some short-term panic, and people start selling out of the stock. So emotionally, or the emotional side of your brain might start to tell you that maybe things are bad and that you should get out. And what the investment thesis does is it gives you something to look at objectively and reassess on whether the company is still on track to deliver what you first thought it would. If it's not, or the numbers are vastly different to what you predicted, so they're no longer growing, or sales aren't where you thought they would be, or they're spending too much money, it might be time to close out your position and sell. However, if it is just some short-term noise creating those price movements and, the market doing what it does, taking the approach of reviewing your investment thesis will allow you to hold your conviction throughout troubling periods. And as a caveat, with that being said, I'm not advocating for holding on to companies that are losing money and you just continue to hold forever. But having a plan with each stock will help you make these decisions easier. I know personally I've fallen into the trap where I have sold on some short-term price movements thinking that it was the end of a run, and the stock has gone on to double. And on the other side of that, I've also held on to a stock that I thought was a winner that just kept losing. So this is why that thesis is so important. It will help make these decisions less emotional and more rational and easier to make when you're inevitably faced with one of these decisions. So when building out your analysis, you don't need to use every single tool under the sun to help build out a thesis. However, it helps to try and stick to a similar model each time that you can do it just for comparison purposes. Some theses can be pages and pages long, while others might only be a few lines around why you like the company. And as you get more experienced in doing this, you'll start to know some of the analysis you really like to add in and some that you feel might not be necessary. So now that we understand what a thesis is, what are some of the things we should think about when we're looking at a company when trying to build a thesis out? So when building out a thesis, I like to start at the top with macro. So I start to look at industry, country, any macro trends that this company is operating in. Really helps to give me a good understanding of sort of where I think the business will be going in the future and also anything to look out for. I might do some industrial analysis. What kind of space does this company compete in? What sort of value do they offer compared to their competitors? Which then takes me on to the next point around competition and who's competing against that company. Who are their main sources of competition through either direct competition, as in companies that compete against them, or by way of substitution. So if I think about Coffee Co., it could be a direct coffee supplier, or it could be a substitution like a tea or something else that could be seen as a competitor. Once I've sort of done some of those macro trends, I then start to look at some of the micro trends or the more company-specific information. One of the main things to kind of look for on a micro trend or a company trend is growth indicators. So I'm thinking about things like a company's earnings growth or their revenue growth if there is no earnings. I'll potentially look at both of those anyway. If it's a subscription model, how many more subscriptions are they growing? Or from a customer growth point of view, how many more customers are they acquiring each year? Then I might look at things like free cash flow. Is that growing? Or even balance sheet growth. And depending on the maturity of the company, that will really determine which of these indicators you're going to look for. I suppose one of the main things to make sure when I'm looking at it is that the company is growing and it's growing at a rate that fits my goals and my portfolio and all of those sort of things that we've touched on previous episodes. And then we might move on to some of the fundamental indicators like price to earnings ratios, earnings per share, dividends or dividend yields, and anything else that we can take to really figure out whether the company is worth buying. It's also a great tool for comparison. So using things like a PE ratio to analyze within an industry. So if a given industry, call it the coffee industry, is trading at a PE of 20 times earnings, and I've just made that number up. If Coffee Co. is only trading at sort of 10 times earnings, you might say, hey, that's cheap. Or it could be at 30 times earnings and it's way above what its rest of its competitors are at. So it really helps from a comparison point of view to look at some of those ratios as well. And then lastly, I might analyze things like operational efficiencies just by reading through a company's report. So are they doing things to bring their costs down? And you might see that when you start to look at some of those growth indicators that I talked about. So as they're driving efficiencies through operations, you'll start to see some more incremental free cash flow, for instance. And then finally, there's things like competitive advantage, or what's often phrased as a company's economic moat. So think of these things like a moat on a medieval castle. So the moat's built to keep rivals at bay or out. And you think about moats from a business point of view in the same sort of way. Do the business that you're looking into do they have enough of a moat to be able to keep their competitors at bay? And so some of the things we might look at when we talk about an economic moat, first up is things like the network effect. So a network effect occurs when the value of the company's services increase for both new and existing users as more people use that service. So I think one of the easiest examples of network effect is something like eBay or any other sort of marketplace. For example, with eBay, millions of buyers and sellers give the company an advantage over other online marketplaces. And the more sellers that are on eBay, the more likely buyers are to find what they're looking for at a decent price. And the more buyers there are, the easier it is to sell things. So they're growing bigger and bigger based on their network. So next up, we have things like intangible assets. So think of these as things like patents, a strong brand name, regulatory licenses, or other assets that can prevent competitors from duplicating a company's products easily. Or it could allow the company to charge a significant price premium. So one of the most notable examples of this are the big pharma companies in the US. So when their patents expire, generic competition can quickly push the price of any of their drugs down, 80, 90%. So for them, an intangible asset is their patents that keep their price really high because no one else can produce that product. Then you move on to things like cost advantage. So companies that might have a structural cost advantage can either undercut their competitors on price while earning really similar margins, or they can charge market level prices while earning an even higher price. So I think of cost advantage of someone like an Amazon who has these really large supply networks, and they're able to do postage at such a cheaper price than other people, and that really gives them advantage because they can sell their products cheaper than their competitors and make up for that with the cost advantage that they would make up for in the logistics. So then you have things like switching costs. So when it would be too expensive or too much effort to stop using a company's products, so that company often has real pricing power. I like to think of this as, I suppose it's not as relevant now, but telcos a couple of years ago, all your products were locked into 24-month contracts. So it actually made the switch to another competitor really difficult and expensive in most cases because you need to pay up fees. Now, I think those are gone, but it's just the best sort of example I can think of at this point in time. Finally, with Moats, you have what's called efficient scale. So that's all about like a niche market that's effectively served by one or a small handful of companies. That generally means efficient scale might be present. So a really good example of this is concrete companies. So it's too expensive to ship concrete a certain distance. So what you'll find is a lot of small geographic areas are served by one concrete company, and as it gets outside of that area, there'll be another concrete company because it just becomes too expensive to ship concrete a certain distance. But given the margins within that business, it's too capital intensive for two or more competitors to be within that one area. There's a great book that's been written on economic moats and competitive advantages called The Little Book That Builds Wealth, and it's by an author called Pat Dorsey. I think it's a really great read and you should check it out, but it's part of a whole series of books on investing under the Little Book titles, and those whole series is a really great read for anyone looking to grow their investing knowledge. So now that we've been through all of that, you should now have a really solid understanding of the business that you're looking at and the direction that you think that company is heading, and if you think the current price is worth buying at. So I didn't cover off any valuation techniques, things like discounted cash flows or anything like that, as that'll probably take another whole episode. But for the purpose of this episode, let's just believe that, the efficient market hypothesis is correct and that the market has priced in the stock at its fair current value. And what we're trying to look at is whether we think it's going to grow into the future. So you may go through and start conducting this exercise of building out a thesis and find that you think a company is overpriced and not go ahead with the investment, or you might just determine a price which you think you would get into the stock in the future. So don't be discouraged though, you haven't wasted your time. You may have avoided making a big loss because you did the homework, and you've also built some really good knowledge around a new space and an industry. And while completing this exercise, you may even go down the path of finding another company that you like even better. The more you create these theses, the easier they will become, and the more you'll find what metrics you prefer to pay attention to when you're doing your homework. And lastly, you need to jot down some points on what factors you would see yourself selling and what your exit strategy would look like. So, is there a change in direction that the company takes that you would disagree with and you would sell? Is there a price that you want to get out at? And this will really help clear things up when you're trying to make a selling decision. And that's pretty much how I go about conducting an investment thesis. I'd love to hear from you guys if there's something different you do, or if you think that there's a really key piece that I've left out. I hope you've been enjoying the content so far, and if you have, please hit that subscribe button or leave me a review. And as I said at the top of the show, if there's anything further you would like me to touch on, feel free to email me at info@capitalmediagrp.com. Now, following this episode, I'd encourage you to go out and start to analyze a few companies of your own and see where you land. Remember, no investment thesis is perfect, and you will be forever crafting how you perform this with a lot of trial and error. Investing's all about the journey. But hopefully this episode has helped you start building your own ideas and forming your own basis for why you would get into a company. In a few weeks' time, I'll go through an investment thesis of my own, and I'd love for one of you to send through one of yours, and we could potentially go through it in a future episode. And that wraps us up for the show today, guys. Thank you. I hope you enjoyed it, and have a great week.
Please remember, the information and opinions provided in this podcast is general advice only and does not constitute financial advice. This podcast was created without knowing individuals' needs, financial situations, or investment objectives. The host of this show may hold positions in the companies discussed. Please remember, before considering any investment, please read the product disclosure statement and consider speaking to a licensed financial professional.
Lunch in the park? Check. Hand sanitizer? Check. Cancer screening? Done. We've all adapted to a new way of living. Keep your healthcare on schedule with Johns Hopkins Medicine, where your health and safety are our highest priorities. We're ready to care for you through virtual and in-person visits across Maryland and the greater Washington region. Your health, our experts, safely caring for you. Schedule your care now. Learn more at hopkinsmedicine.org/safe.
Harvard Business School Online offers a flexible and engaging way to learn vital business concepts. Our professional certificate courses are offered 100% online and can be completed on your own time. Try a free business lesson at hbsonline.info and discover how Harvard Business School Online can help you take the next step in your career. Go to hbsonline.info today.